back to Brashenomics. I'm Ben Brashen, and we are joined today, well, it's Monday, so we're going to talk a little bit about mortgages. Ryan Leopold joins us, and, hello, Ryan.
Hey, Ben. How you doing, buddy?
Good. How are you?
Good. Good to be back.
Yeah, it's good to have you. And this is interesting because today, talking a little bit about QE3 or quantitative easing, and not our third string quarterback, that would be QB3, or RG3, anyways. And also this GFI. I mean, we're all of a sudden mortgages back to acronyms like LTV and DTI. Let's talk a little bit about what these new government programs, stimulus, might really mean for mortgages.
Yeah, well, I think the first thing to really understand is understanding why the government comes out and the Federal Reserve comes out and does these quantitative easing programs, which is now we're on the third phase of that, which is really, in essence, just printing money. That's the only real tool that the government has to try to stimulate the economy, which is to print money and get money into circulation to try to lower interest rates. When you lower interest rates, the cost of borrowing money for consumers and businesses go down. Hence, ideally, those consumers and businesses are reinvesting into the economy, hence, so it's to improve the economy. So really, that's what happened over the last couple of weeks, is that's coming out now, the QE3, and more money just being put back into the economy.
And that's to the tune of $40 billion per month.
Yep, that's a lot.
Yeah,
that's a big bowl to fire.
I think to kind of a little bit back a conversation around it, it's a lot of money, and at least from your clients, I don't know if you see this, but I don't know if people are like, wow, rates are at 3.25 instead of 3.75. Now I'm going to go buy a house. It seems that the lowest rates ever, just getting a little bit lower and a little bit lower. Quit getting people off the fence at some point in time.
You'd think so. I mean, the interest rates have pretty much been, and we've seen this multiple times, the lowest they have ever been. And the government really is printing money to make that possible for everybody. Again, just try to stimulate the economy, get people to buy houses and do other things. So I think what's interesting about it is kind of the other things that come up from these programs and where that money is coming from. The government is printing the money to put into circulation. But on the other side of things, they're actually using mortgages and using mortgage-backed securities to actually increase the cost to consumers. So interest rates are really low, but in reality, they should actually be a lot lower than they are today, which is pretty wild to think about.
So why should they be lower? Let's talk a little bit of that, because now we have the GFI coming in. Or go ahead.
Well, just think about it that, since everything went kind of sideways in 2007 and 2008, the government is actually, through Fannie Mae and Freddie Mac, have actually increased rates just on simple price adjustments to the consumer based on risk 7 times just since 2008. And that's things like lower credit scores, higher loan to values, things like that affect the cost that a consumer pays for a mortgage. And that's increased 7 times since 2008. So that's one way that the consumers are being hit and actually having increases in what interest rate they should be sold from the open market.
So you have the Fannie Mae and Freddie Mac who are raising their fees, while the Fed prints a bunch of money and puts it into Fannie Mae and Freddie Mac. So literally, the money that's being put in by the Fed is now being scraped off the top by Fannie Mae and Freddie Mac with higher fees. Exactly.
So you have the Fed attempting to keep interest rates low. You have the government coming into the Treasury, and a lot of that's since the government owns 97% of Fannie Mae and Freddie Mac, they're using that institution as a tool to raise capital, not only to cover risks that, high risks that are involved in mortgages just in general and default rates, but you have money that's being generated by Fannie and Freddie to support other government programs like unemployment benefits, Medicare benefits, and really just other kind of taxes that go for employment taxes. So those have been increased 3-4 different times over the last year and a half, really just increasing the cost to the consumer that they get at that end mortgage.
Well, and then, of course, what I think the big kicker here is that it's not done. The money's not done being scraped off the top. And now, you don't borrow from Fannie Mae. I don't. Nobody who has a loan, you might be owned by Fannie Mae, but they're not your servicer. Now you have big banks getting involved with a stockpile of money flowing through them.
Yeah, so the big banks
It's not
actually...
really a stockpile, is it? It's money they're just printing and then putting through the banks.
Well, as you collect more and more money, when you have refinances going on, you have HARP going on, you have FHA streamlines going on, you have people actually buying homes again, creating a lot of business for these banks. So they're originating all these loans, and 70 to 80% of all originated loans are actually sold back to Fannie Mae and Freddie Mac. But Fannie, like you said, Fannie and Freddie are not actually out originating loans. It's big banks, mortgage banks, brokers, everything else that actually started. So yeah, there's multiple people pulling from these added fees, even though rates are at the lowest level really that they ever been today. They really, actually should be lower.
So you have the Fed printing money, Fannie raising their fees, and banks not necessarily being forced to use that money and give the best possible rate they can, only low enough to be competitive with other banks. So ultimately rates could be lower, but other people need to make money before rates get lower.
Well, remember, the kicker here is that the government and Congress is actually using Fannie and Freddie to raise these fees to support other programs. Okay, and so this is just a tool they've done 3 to 4 different times so far just in the last year, and that doesn't mean they're not going to stop moving forward. So it's an interesting tug of war between the Fed and the Treasury and Fannie and Freddie that keeps the rates low and raises the cost of rates. So it's kind of this interesting battle that goes on behind the scenes that not a lot of people know about.
Yeah, well, and you and I had also talked once about how banks are pretty much making 6 times as much money during the refinancing to lower rates than the actual consumers, to the tune of about $12 billion versus the $2 billion consumers will most likely save.
It's crazy, and especially through the HARP refinance program. And we talked about this a couple months ago, that the HARP refinance program came out to help people refinance it if they were at all underwater on their homes. But a lot of people have to go back to their original servicer, being Bank of America, Chase, or Wells, to take advantage of that program. And they're increasing premiums on top of the normal Fannie and Freddie fees by half to 3/4 in rate in some cases, just simply because the consumer can't go anywhere else but back to that original servicer of the loan.
It doesn't seem to all make sense, does it? I mean, I guess if you're the big bank or you are a government who's trying to make more money because you've overspent, and you control the printing of the money and the taking of the money, I guess it does. But from a consumer standpoint, it doesn't make sense that the government tries to lower rates, but then it's so hard to trickle down that far.
I think at the end of the day, I think it's good to be educated and knowing all the facts behind these, because a lot of people just hear, like you said, the acronyms of QE3 and G-fee and all this stuff. And let's just keep perspective. The interest rates on a 30-year fix are 3.5% or lower in some cases. So let's just go and sit back and enjoy it. And if you need to refinance. If you're looking to buy a house, it's a great time to take advantage of really, really cheap money. And let's make it as simple as that.
Well, Ryan, thanks for joining us. We do have to go to break, but when we come back, we're going to continue talking with Ryan, Jan Silvar, and Mr. Matthew Royal. We'll be right back after this break.